Western nations, including the Europeans, said to be discussing a price cap on Russian oil that would be between $65 US and $70 US a barrel. We are joined now by Andy Lipow, president of Lipow Oil Associates. Andy, always great talking to you, and thanks very much for coming on the show. There seems to be a certain amount of cynicism or skepticism about this thing because this price cap is above the price Putin is currently getting for his oil.
Well, that's exactly right. When we see $65 to $70 and we see that Urals is currently trading on a delivered basis between $60 and $64 a barrel, the market reaction is that this is going to have a limited impact in the supply disruption, and oil will continue to flow, especially to China, India, Bulgaria.
I see Halima Croft, the RBC oil watcher. She reckons this is just a way to keep Russian oil on the market. You're not defunding Putin here.
Well, ironically, the fact that the supply disruption is going to be mitigated has resulted in oil prices falling nearly $4 a barrel. So while Russia continues to sell its oil, the market is really doing the work to limit their revenues, saying that there's going to be ample supply.
What is it? Is just Western nations just don't want to go the whole hog and say, no more, we're just not going to buy Russian oil?
Well, I think you're still seeing European Union and the United States avoiding the purchases of Russian oil, and we're going to see a big reshuffling of supplies around the world as the European Union looks for alternatives such as the U.S. Gulf Coast or West African, or even increased supplies out of the Middle East, such as Iraq.
Looking at the inventory numbers that just came out from the EIA, apparently crude inventories in Cushing, Oklahoma, a crucial choke point for oil, dropping to the lowest in more than 2 months. So does that point to a fundamentally tight U.S. oil market?
Well, I think the crude oil market continues to be tight because we've been relying on declines in the Strategic Petroleum Reserve to make up the difference. So while commercial stocks over a long period of time seem to be unchanged, that's because we've withdrawn over 200 million barrels from the SPR. So I do believe as we go forward, crude oil supplies remain tight, and what we really need to see is more oil coming out of the ground from new production.
We've heard so much about these high diesel prices, but our partners at Bloomberg reckon diesel demand has been continuing to taper off, and distillate stockpiles have now gone up in 5 of the last 6 weeks. So is this much ballyhooed diesel problem, is that easing?
Well, I don't think that we should really be claiming success yet as we go into the colder winter months. Of course, there's been some diesel destruction because of lower economic growth. We've also seen natural gas prices come down in the European Union, which has impacted on oil to gas switching. But given the low stocks that we have here in the United States and cold weather in the Northeast, I think it's really too early to celebrate. And what you really need to see is more diesel supplies. And some of that is actually coming from new refinery startup in Kuwait.
What was that? Sorry, a new refinery in Kuwait?
A new refinery in Kuwait is starting up, and that is going to add to diesel supplies, especially into Europe. This is happening at the same time that the French refinery strike is ending, and that's easing the shortages that we had seen over the last 4 to 6 weeks.
You guys in America, your crude production has gone up a bit, but it's pretty stable right now at about 12.1 million barrels a day.
This is quite concerning because what we've seen is increasing production costs, increasing fracking costs, and as a result, the EIA has been revising downwards its forecast for oil production next year. At one point, it was 12.99 million barrels a day. That has been revised down over the last 5 months to 12.3 million barrels a day. So this is certainly as a concern as world oil demand, is projected to increase next year.
Andy, you've been around the oil market for a while. I got to get your take on this Wall Street Journal story that the Saudis were considering offering an olive branch to Washington in the shape of a small increase in production. And that's after Washington apparently blocked a lawsuit in America over the murder of that journalist, Jamal Khashoggi. Is that plausible that the Saudis would actually increase production as a gesture of goodwill?
Well, I don't think they're going to increase production at this December 4th meeting, given that oil prices have fallen about $10 a barrel over the last week. But we could see them do some action at their January meeting as we see how these European Union sanctions play out on Russian oil supplies. But clearly, the oil market is looking at the Biden administration granting Mohammed bin Salman immunity and thinking there's some back office trade that has occurred here that will, ameliorate any supply disruption.